We do have Rob Lees with us from Mortgage Choice once again, and we're talking about construction loans today. Welcome, Rob.
Good to be here
Rob.
again. Yeah. Hi.
So what's the difference between a construction loan?
And a normal loan.
Yeah.
Well, a construction loan is where the purpose is construction finance when you're doing building work.
Okay, so
Yep.
we're talking about people who've maybe purchased a block of land and a
Well,
package.
it could be a whole lot of things. So there's look, everyone at some point is going to need some form of building finance, construction finance. It doesn't necessarily mean it's going to require a construction loan, but
Yep.
it might be if you're going to renovate the kitchen, bathroom, maybe a bit of a spruce up around the back, or whatever it might be. You need some kind of finance to do it, and
To pay for
I
it,
think
yep.
Everyone at some point needs that kind of money. So the best way to fund it is with cash, because if you've got cash, you've got control.
Yeah.
But not everyone's got cash. And if it involves structural work, you do need to get a construction loan.
So you touched on this a few weeks ago, and I remember being quite surprised because I have never built a house. I've always I haven't had a construction loan before, and that there are different parameters in releasing funds, isn't it? So it's a different, because builders require their payments differently.
Yep, that's right. And I suppose, like for most people doing a little bit of work, it's easy enough just to get cash out from the lender.
Yeah.
And-
So what
and,
actually specifically constitutes a construction loan?
It's normally if it's a major job, if it involves structural work. So structural work, the lender will require a construction contract. Normally it's a construction contract with the builder, or it might be an owner-builder loan. So there's a few lenders that do owner-builder loans. Most lenders don't do owner-builder loans because they don't like owner-builders, because owner-builders always run out of money. I've never done an owner-builder loan where the
Before it's
owner-builder
finished.
hasn't run out of money. So,
Interesting.
so most lenders don't do it, but otherwise it will be a construction contract. And the nature of owner-builder loans is the lender then releases the funds bit by bit, according to each stage of the construction project as it's completed.
Is there ever a situation where if you went to a builder, for example, and you made an agreement that, just for argument's sake, this build is going to cost $100,000, you just said then the owner builders often run out of money and need more.
Not
Does
often,
that ever
always.
Always. Well, that's right. You did say always. Is it a case of? Is it like a contract that if the builder company that you went to said it's going to cost $100,000, do they come along and
They
say,
don't run out of money.
Well,
110?
It's fixed
$110?
price.
it's supposed to be a fixed price builder's contract, but
Sometimes there can be problems, right? You can come across,
never fixed.
hard rock that they can't.
That's right.
They've
There's
got to get
always contingencies, and I still
Right.
find that people, even who have a fixed price contract with a builder, usually there's all sorts of upgrades and things like that. They normally need more money. So
Yeah.
even when they're doing it through a builder, most people run out of money.
Wow.
So
We had
these
an
are the
example,
challenges.
Rob, where some clients had $30,000 in site costs that weren't in their building contract, which meant
That's a phenomenal amount
It's-
of money.
it is a phenomenal amount.
I'm so deterred by ever building, I tell you, from the stories I hear.
And look, it is possible to get, I should say, with non-structural work, it is possible to get cash out with some lenders
Yeah.
to do that work. However, I should say, if people do that, and some people do, you're actually in breach of your mortgage contract.
Wow.
If you start the work, and I've had clients who've done this, they've started the work because they've got cash, sold a property, they start the work, then of course they run out of money, and then they actually can't get any more money from that lender because they're actually in breach of their loan contract because they've started that work without telling the lender. So these are things that people need to be aware of anyway.
Yeah. And so with a construction loan, we've sort of just covered off some of the risks and challenges associated with that.
Sure.
But what are the main things that you would see?
So I think the main thing, as I said, is overspending and running out of money.
Yeah.
So that's got to be
And a fixed price
one.
contract doesn't necessarily shelter you from that.
It does, but I think you've still got to make sure that you really have made enough allowances for contingencies.
Yeah.
Well, that's what they're going to come to you, and that, because you say it always happens,
Yeah.
that you're going to make a suggestion that you have a contingency.
That, and I always say that, and they always still run out of money. But you kind of need backup, and sometimes the backup might even be parents who can kind of come to the rescue or something like that. Or I've had people who've had to owner builders right now who've had to sell properties or a property to be able to fund the next stage because because they couldn't get the funding. So that's probably the number one thing. I guess the other risk is, particularly if people are doing renos, extensions, we might call it the risk of over-capitalising. And it's possible to spend too much on your property. Probably not as much now because property prices have gone up, but certainly a couple of years ago when the average property in the mountains was only, $400,000 or $500,000, and if you spent $200,000, you were potentially overcapitalising. Whereas now you'd probably be more inclined to get away with it, but you still have to be fairly careful.
And I guess too, with like what we were talking about with Terry, was around the specifications when you're building, like in that overcapitalisation part. Like, don't put marble floors and gold taps in if that's not what the general area of where you're building is, because that would leverage to.
Absolutely. And like if you imagine an area that your house is already worth $600,000 and all the other houses are about $600,000 and you're going to spend $500,000 on an upgrade, you're probably not going to get the valuation you need. So you're not only going to be overcapitalising, but it could very well be that you're not going to get the value that's sufficient to actually get the loan.
Because how do the banks determine a value in that space? Like if you're buying a normal home, the purchase price is X, and you need Y as your loan. How do the banks actually understand how much they can lend you for these construction loans?
When it comes to a construction loan, what the bank requires is the building documents, which they will use to do a valuation. So the fixed price contract, the building plans and specifications, detailed prime cost items of all the inclusions and all that sort of thing. And then that's sent to a valuer, and the valuer does an at completion valuation. So, so you've got a block of land worth $400,000, and the build is another $400,000, and hopefully it's going to be valued at completion at $800,000. Although that isn't always the case, and so there can be risks there with valuation.
So, what factors where it wouldn't be the case though?
Well, they're still comparing it. They're looking at all that and saying, okay, comparing that new property with what other properties are selling for, other like properties. And there's all sorts of risks in that. So it might be here in the mountains, if someone's doing a big build and they're comparing with other properties in the area, construction costs are usually higher in the mountains because they've got to put in bushfire resistant materials and so on. And so the spend might be quite high, but when they compare with other properties selling similar properties,
always
it may be that it's just too high, and they've actually got to bring the valuation down a bit. Yeah,
because a 4-bedroom home might be worth X, but then to build a 4-bedroom home with new fire ratings and etc. might cost you a lot more than if you were to buy an established property that hasn't had to meet those restrictions.
And that can be a big risk. So again, it's another issue of you've got to have some working capital to pull this project off.
Yeah.
Fantastic information, Rob, as always.
So we sort of we just let Rob cover off on his last question around the applying for the construction loan and the additional documentation. So you think...
Yeah, I've mentioned that, but I think the thing that I'd suggest to people is when you're looking at doing any sort of any kind of construction work, talk to the mortgage broker first.
Yeah.
A lot of people run a bunch of different scenarios. I think every family at some stage in their life wants to work out, should we extend or should we just sell and upgrade?
Yeah.
Those sorts of questions. Can we do this? Can we do that?
Crunch the numbers.
I can crunch numbers.
Yeah.
I can give some guidance to sort of help on the next stage in the project, and then we can talk about documentation and all that kind of thing as well.
Perfect, awesome. Rob. So if anybody wanted more information, they can call into Mortgage Choice Blue Mountains and Penrith at Hope Street down in Blaxland, or you can always give them a call on 024739 9749.
Thank you so much, Rob.
Thank you.
Thanks,
I learn
Rob.
so much from our sessions every fortnight.
That's good.
I appreciate it a lot.